Market Recap. I'm Daniel.
And I'm Mira.
You know, if you were watching your portfolio today, you probably felt a bit of whiplash.
Oh, absolutely.
It just isn't every day that you witness a massive 5.5% plunge in crude oil colliding head-on with, a record high for the Nasdaq.
Yeah, it was a wild ride.
Totally. We had the U.S. and Iran locked in this high-stakes narrative tug-of-war that sent the energy markets into an absolute tailspin. And yet, amidst all that geopolitical chaos, the relentless spending on AI infrastructure just kept holding the broader equity market aloft.
Right.
So today we're going to give you a complete breakdown of why oil crashed despite official denials of a peace deal and exactly how tech mega-cap spending is holding the broader market up right now.
It really is a masterclass in how physical commodity markets and digital infrastructure equities are operating in, like two completely different realities right now.
Completely different realities. Now, before we kick off session one, I just need to clearly state that this deep dive is for market context and discussion only. It is not personal investment advice or an investment recommendation.
Exactly. We're here to help you understand the baseline you are operating against.
All right, let's kick things off with session one. So what set the stage before the U.S. session opened on May 27th?
Well, to really understand the opening bell today, you have to look at the carryover narrative from yesterday's session, May 26th. The overarching shadow on this market, for months now, has been the U.S.-Iran conflict. Ever since things escalated into Operation Roaring Lion back in late February, the global energy complex has just been operating on a razor's edge.
Yeah, that tension has been constant.
Right. And then the Islamic Revolutionary Guard Corps closed the Strait of Hormuz, and, we cannot overstate the physical reality of that bottleneck.
No, we really can't. For those listening who might not track global shipping routes every single day, roughly 20% of the world's petroleum liquids flow through that exact strait.
20%. That is massive.
It is the ultimate global choke point. You choke that off, and the entire world feels it at the gas pump and in global supply chains almost immediately. It's just a structural nightmare.
Precisely. But yesterday, we started hearing these emerging whispers about a Qatari-mediated truce.
Right, the rumors.
Yeah. And the linchpin of this potential deal seemed to hinge on unfreezing up to $24 billion in Iranian funds. That rumor was the simmering, unresolved backdrop as the Asian and European markets opened earlier today.
Yeah, but what strikes me is how the world's central banks reacted to that unresolved energy shock before the U.S. even woke up.
Oh, they were panicking.
Literally. If you look in the international wire overnight, central bankers were practically tripping over themselves to sound hawkish alarms. You had the Bank of Japan's Governor Ueda explicitly warning that supply disruptions are becoming increasingly common.
Right.
He was stressing that these energy shocks threaten to trigger second-round inflation effects through higher wage demands in Japan.
And it would just pause there for a second. That is a massive paradigm shift for Japan.
Totally.
Historically, they've fought deflation. So for the BOJ to worry about an oil shock bleeding into domestic wage inflation shows just how severe this Operation Roaring Lion disruption has been.
Absolutely.
But it wasn't just Japan. Over in Europe, the European Central Bank's Isabel Schnabel was pushing a very hard line. She explicitly stated the ECB should hike rates in June, regardless of whether a Middle East peace deal happens or not.
But wait, isn't that a bit of an overreaction from the ECB? If we are hearing whispers of a truce and the possibility that 20% of global oil might suddenly come back online,
right?
Why are they doubling down on hiking rates right now?
It's a great question. But you have to view this through the framework of central bank credibility as an inflation anchor. These policymakers know that they cannot afford to flinch at the first rumor of a peace deal. If they pause rate hikes based on some Qatari rumor, and then that deal falls apart tomorrow, inflation expectations among businesses and consumers could become entirely unmoored.
So they have to stay rigid.
Exactly. They're being rigid because, historically, getting caught flat-footed by a transient oil shock just destroys a central bank's credibility for years.
Wow.
Even the Reserve Bank of New Zealand, which held their cash rate steady at 2.25% earlier, delivered incredibly hawkish forward guidance. They warned that broken supply chains and high oil prices mean rates will likely need to be higher going forward.
Okay, so if we sum up the overnight mood, the world was bracing for sticky, energy-driven inflation right up until the opening bell. The fear was absolutely palpable.
It really was.
We are going to take a very quick pause right here, but when we come back, we'll launch into session 2 and explore how all that hawkish tension violently unraveled once U.S. traders hit their desks.
We'll be right back.
Welcome back. Let's move straight into session 2. So what actually moved markets during U.S. trading hours today?
Well, the headline event, without a single doubt, was the massive plunge in crude oil. The physical commodities market essentially ignored all that hawkish central bank posturing we just talked about.
Ignored is an understatement. I mean, I was watching my screens mid-morning, and the bottom just completely fell out of crude. Can you walk us through the scale of that sell-off?
Oh, it was explosive.
Yeah.
We watched WTI crude plummet from an intraday high of just under $93.69 a barrel, all the way down to a steep low of roughly $87.77.
That is insane.
Yeah, it eventually settled right around $88.68. That is a massive 5.55% drop on the day.
Wow.
And Brent crude followed suit in almost perfect lockstep, dropping 5.31% to settle near $94.29.
And the timeline of how we got that 5% drop is just pure geopolitical whiplash.
Oh, totally.
You can practically track the market's confusion throughout the trading day. Pre-market, early this morning at roughly 7:18 a.m. Eastern Time, Iranian state TV dropped an absolute bombshell. They claimed they had an initial draft memorandum of understanding to end the blockade. They were openly talking about restoring commercial shipping in exchange for U.S. military withdrawals.
But, you know, the market barely had time to process that before the U.S. pushed back.
Right.
Right in the middle of U.S. trading hours, at roughly 10:34 a.m. Eastern Time, the White House aggressively denied the report. They publicly called it a complete fabrication and basically told the international community not to believe Iranian state media.
But then, and this is where it gets crazy, just before 1 p.m., specifically at 12:58 p.m. Eastern Time, President Trump steps in and adds a massive amount of fuel to the fire.
Yeah, he really did.
He stated on the record that the strait would be open to everyone. Now, he noted that a deal wasn't finalized, and he wasn't totally satisfied with the terms yet, but he explicitly said things are moving quickly.
It's a dizzying sequence of events.
It really is. And I have to push back on the market's reaction here. When we talk about geopolitical brinkmanship as unhedgeable tail risk, isn't the market catching a falling knife by aggressively selling off oil before the pen actually hits the paper?
I see what you mean.
Like, think about it. A White House denial and a vague "we're moving quickly" comment from the president doesn't magically clear the physical mines from the Strait of Hormuz today. If this deal collapses tomorrow, oil goes right back up.
I completely understand why it feels like catching a falling knife. But let me challenge that reflex to view this as just unpredictable noise.
Okay, lay it on me.
If we view this morning's timeline through a game theoretic lens, the market isn't crazy at all. What we are watching is a classic public negotiation strategy playing out in real time.
How so?
Think about the mechanics of international diplomacy. Iran leaks a draft framework to state TV. Why? Because they want to publicly anchor the terms of the negotiation.
Specifically demanding that U.S. naval withdrawal.
Exactly. They are setting a public baseline. The White House, naturally, has to call it a complete fabrication. If they don't, they lose their negotiating leverage, right? They can't look eager to accept Iran's first draft.
That makes sense.
But then the president comes out and signals that behind closed doors, a deal is actually very close. The market sees through the public posturing. It's a prime example of markets pricing ahead of physical reality because traders see the diplomatic endgame forming even if the physical ships aren't moving yet.
Okay, yeah, that makes a lot of sense. The market is looking past the press releases and trading the subtext. But you know who definitely wasn't looking past the posturing today?
The Fed.
The Federal Reserve. We had this wild real-time disconnect between the commodities floor and the Fed. While traders were busy pricing in Middle East peace and crashing oil prices, Fed governors Lisa Cook and Neil Kashkari were out on the wires warning that the inflationary shockwave from the Middle East could persist.
Right.
Governor Cook even explicitly stated she is prepared to raise rates if disinflation stalls out.
Which perfectly illustrates the tension of stale macro data versus real-time pricing.
Yeah.
The Fed is setting macroeconomic policy based on their fear of yesterday's $95 oil and the supply chain bottlenecks it caused. Meanwhile, the market is already happily trading today's $88 oil.
It's a fascinating standoff. So, to wrap up session 2, we essentially saw geopolitical hopes completely crush oil prices, brushing aside those hawkish Fed warnings in the process. We're going to take one more quick pause here. Next, we will look at how corporate America handled this wild ride and what catalysts you need to watch for tomorrow.
Stay with us.
All right, moving into session 3. What were the key corporate events today, and what should we watch next?
Well, while the broader S&P 500 spent the day virtually flat, closing right around 7,520.36, the tech sector was an absolute juggernaut.
Unstoppable.
The Nasdaq hit a record close today of over 26,674.
Which is pretty incredible when you factor in the massive geopolitical uncertainty we just spent the last 10 minutes talking about.
Yeah, it's wild.
This feels like a textbook case of tech mega-cap spending, masking broader fragility in the underlying economy. The broader market is flat and nervous, but big tech is just plowing ahead.
They are plowing ahead, and the news flow backing up that massive spending was relentless today. First, during U.S. trading hours today, May 27th, we saw Micron officially cross a $1 trillion valuation.
Wow, $1 trillion.
Yeah, riding the momentum of a recent 19% surge in their stock price.
Yeah.
And then, right after the closing bell at roughly 4:06 p.m. Eastern Time, it was reported that Amazon struck a massive $6 billion deal with Snowflake.
Specifically focusing on agentic AI chips, right?
Exactly.
Let's pause there for a second because, we throw around a lot of terms in this space. For listeners trying to keep up with the tech jargon, when we say agentic AI chips, what exactly does that mean, and why is a $6 billion deal so significant?
That's a great point. Up until recently, most AI was generative. You ask a chatbot a question, it generates text or an image.
Right, like ChatGPT.
Exactly. Agentic AI refers to systems that act as independent agents. They don't just answer questions, they execute complex, multi-step workflows across different software platforms without human intervention.
Oh, wow.
Yeah, to do that at scale requires a completely new level of computing architecture. And when hyperscalers, which are massive cloud providers like Amazon, Microsoft, and Google, start building out this infrastructure, the capital requirements are just mind-boggling.
And they are all terrified of falling behind. It really highlights the theme of AI CapEx as a cycle-agnostic arms race.
Totally.
These hyperscalers do not care if the Fed hikes rates in June or cuts them, or if oil goes to $100. They are playing a decade-long game, and they cannot afford to lose the AI infrastructure war. Even Fed Governor Cook acknowledged today, at 3:56 p.m. Eastern Time, that AI will eventually provide a long-term productivity boost to the broader economy. To offset that massive spending, we also saw Meta launch paid AI chatbot subscriptions today during U.S. trading hours, clearly trying to find immediate revenue streams to justify these capital expenditures.
Exactly. And, I think it's important to note that this tech optimism was partly supported by incredible resilience in the Treasury market today.
Yeah, the bond market was rock solid. We always talk about discount rates as financial gravity. The higher the yield, the harder it pulls down the present value of future tech earnings.
Right.
But gravity was stable today. The bond market smoothly absorbed a massive $70 billion 5-year U.S. Treasury note auction at 12:45 p.m. Eastern Time today. It cleared right at a 4.182% yield, and the benchmark 10-year yield actually drifted slightly lower on the day to roughly 4.481%.
Which brings us to the close of a day that, frankly, left a lot of folks scratching their heads.
It really did. The joke going around the trading floor at the closing bell today was that average investors were out there checking themselves for physical whiplash.
Yeah.
1 minute, Iranian state TV claims a peace deal. The next minute, the White House calls it a complete fabrication, yet crude oil still takes a massive 5% nosedive. We were saying that if we could just harness the raw kinetic energy of these conflicting headlines, we wouldn't even need to ship oil through the Strait of Hormuz.
Honestly, we could probably power a few of Amazon's data centers with it.
Seriously. But with the Nasdaq hitting a record high, tech investors are popping champagne regardless. It seems the new golden rule for this market is buy the rumor, sell the crude, and just keep buying AI.
So true. Looking ahead to tomorrow, Thursday, May 28th, we have a gauntlet of critical catalysts that could test everything we've talked about.
Let's hear them.
At 12:30 p.m. Eastern Time, we get the April core PCE inflation print. This is going to be the ultimate test of stale macro versus real-time pricing. It's going to show us exactly what the Fed is worried about from last month, right as the market tries to trade today's realities.
Alongside that PCE print, we also get the Q1 GDP second estimate and initial jobless claims, both dropping at 12:30 p.m. Eastern Time as well. Following that data barrage, the Fed's Williams is scheduled to give a speech at 12:55 p.m. Eastern Time. And finally, the EIA weekly crude and gasoline inventories drop at 4 p.m. Eastern Time, which will be heavily scrutinized given today's oil plunge.
A very busy Thursday ahead.
All right, that wraps up our three main sessions, but let's pivot to our 2-minute paper trading segment. As a quick reminder for our listeners, we started this internal portfolio experiment on April 17th, 2026, with an initial sum of $10,000. Today, the portfolio value sits at $11,058.95. That represents a 10.59% return, which is solidly outperforming the S&P 500's 5.53% return over that exact same period.
It's been a great run so far. So looking at today's chaos, what is your trade for tomorrow?
I'm making a major rotation. My decision is to sell XLE, which is the energy sector ETF, and buy XLU, the utilities ETF.
Okay, why the shift?
Here is my rationale. Tomorrow's April core PCE report is going to be the absolute definition of stale macro data. It is going to reflect the peak fears of the oil shock from last month. But as we saw with the massive plunge in crude today, real-time pricing shows the geopolitical risk premium is unwinding fast.
Right. The market thinks a deal is coming.
Exactly. So I am rotating out of fossil fuels.
And why utilities? Traditionally, that's a very defensive play.
It is defensive, but it's actually a backdoor tech play. Energy access as an AI infrastructure bottleneck is becoming the real physical constraint in this market. We just talked about hyperscalers like Amazon and Meta planning hundreds of billions in capital expenditures for agentic AI. But you cannot run a trillion-dollar supercomputer without massive amounts of electricity and cooling. The physical power grid in the U.S. is struggling to keep up with the demand from these massive data centers. So XLU captures that traditional defensive posture against market volatility while simultaneously playing the physical build-out of the AI boom. What about your trade?
Well, I actually agree with your logic on energy, specifically regarding the unwinding of the geopolitical risk premium. So I am also putting in a sell for XLE. However, my buy is going in a different direction. I am buying XLY, the consumer discretionary ETF.
Interesting. Walk me through that.
If we look at energy shocks as a delayed consumer tax, that entire framework is suddenly reversing.
Oh, I see where you're going.
Yeah, when oil is at $95 a barrel, consumers spend more at the gas pump and less at retail stores. But with oil dropping 5.5% today, cheaper crude provides a mechanical, almost immediate relief valve for consumer discretionary spending. I want to capture that upside.
That's a great point.
And to explain why I'm not adding to the tech sector despite the Nasdaq's record high, it's simply a risk management decision. Our paper portfolio is already sitting at a massive 45% weight in XLK, the tech ETF. We have enough exposure there.
I love that logic. It's a great way to play the oil drop without over-leveraging into tech. So let's state our aggregated execution for tomorrow's close. We will sell XLE at a 5.7% weight, we will buy XLU at a 3.0% weight, and we will buy XLY at a 2.7% weight.
Perfect. And as always, a quick reminder to our listeners that this paper trading segment is an internal experiment for entertainment and discussion purposes only. It is not financial advice, and past performance does not guarantee future returns.
To wrap things up today, I want to leave you with a final provocative thought to mull over. We've spent a lot of time today talking about the massive tsunami of capital being poured into AI infrastructure.
Yeah.
If this spending eventually triggers the long-term productivity boom that Fed Governor Cook and others are hoping for, will it actually happen fast enough to offset the persistent inflation of a fractured, deglobalized world? Or are we just building a trillion-dollar supercomputer while the physical supply chains it relies on quietly burn?
Let us know your take on today's massive crude collapse and the AI boom in the comments below, and we'll see you in the next deep dive.